Is 2026 the worst year to invest in Dubai? That's the question flooding my inbox right now. And I get it. You're seeing headlines about oversupply, rising costs, and slowing price growth. Your WhatsApp groups are full of people saying, wait it out. And here's what worries me more than market timing. I've been investing in Dubai since 2003. I've navigated the pre-2008 speculation boom. I've managed portfolios through the global financial crisis, and I've guided clients through the recent resurgence. And in those 20 plus years, I've seen something happen over and over again. Investors who wait for the perfect time end up sitting on the sidelines forever, while investors who buy at the wrong thing at the right time end up trapped in properties that can't rent or sell without taking a loss, because the market doesn't punish you for bad timing, it punishes you for bad execution. So in this video, I'm going to show you whether 2026 is actually as risky as everyone's saying, and the exact type of properties that will thrive while others struggle. Yes, there are real headwinds, and you need to know about them. But before we get into the strategy, we need to be honest about what's actually happening in the market right now. Too many investors either ignore the risks completely or let fear paralyze them. Both approaches cost money. So let's be transparent. There are legitimate concerns for 2026. Mortgage rates are higher than they were in 2021 to 2022, which affects affordability. Price growth has slowed from the explosive gains of recent years. And yes, there is a significant supply pipeline coming. These aren't fake concerns, they're real market pressures you need to factor into your decision. So my advice is to acknowledge the headwinds, but don't let them stop you from seeing the full picture. Understanding the risks is the first step to avoiding them. The supply crisis. That isn't what it seems. Now let's talk about the elephant in the room, the supply everyone's panicking about. Too many investors are seeing pipeline figures showing hundreds of thousands of units scheduled and immediately panic. They think all that supply will actually hit the market and crush prices. We know from experience that just isn't going to happen. The expectation doesn't actually match reality. And here's the reality check. Planned supply and actual deliveries are two completely different things. Yes, there might be 66,000 units scheduled for 2025, but realistic completions will likely land in the 30 to 40,000 range. For 2026 to 2027, those hundreds of thousands of unit plans aren't deliveries. A practical estimate is 45 to 60,000 units per year. And developers consistently deliver only 50 or 60% of what they schedule. This gap between headlines and reality is where smart investors find opportunity while others sit frozen. Don't make decisions based on pipeline announcements. Look at historical delivery rates and factor in realistic completion timelines. The actual supply hitting the market is far less scary than the headlines suggest. Now, I've spent hours digging through delivery data, developer track records, and supply projections to separate the real numbers from the marketing noise. And because this research is critical for anyone investing in Dubai right now, I've compiled it into a free resource. We call it the Dubai Investors Due Diligence Playbook. It includes the exact framework I use to filter out bad deals and identify the resilient ones. You can grab it using the link in the description. The population growth, nobody's really factoring that in, but supply is only half the equation. Let's talk about who's actually going to fill all those units. Too many investors focus entirely on supply numbers and completely ignore demand fundamentals. They forget the housing supply only matters relative to who needs it. Dubai crossed 4 million residents in 2025, gaining approximately 200,000 people in a single year. Even with moderate growth, the city will hit around 4.2 by the end of 2026. This isn't speculation, it's demographic momentum driven by job creation, business relocation, and family formation. When you compare that population growth to the actual delivery numbers we just discussed, 45 to 60,000 units per year, the math is simple. Real absorption will remain strong. The imbalance between real population growth and actual housing delivery is the backbone of Dubai's resilience. Always look at supply and demand together. A market can have high supply and still perform well if demand is even higher. Dubai's population growth is your signal that the fundamentals remain solid. Dubai's safe haven status is stronger than ever, and there's another force driving demand that most people completely overlook. Too many people think Dubai's appeal is just about tax-free income and sunshine. They miss the deeper geopolitical and economic forces at play. In a world facing trade wars, rising taxes, and geopolitical instability, Dubai has positioned itself as the Switzerland of the Middle East. It's not just attracting tourists, it's attracting capital and families looking for stability. This creates a constant underlying demand that goes beyond typical real estate cycles. When global uncertainty rises, so does Dubai's appeal as a safe haven for both wealth and lifestyle. So factor in the macro picture. Dubai's value proposition isn't just local, it's global. That structural advantage supports long-term demand regardless of short-term supply concerns. The real risk isn't the market, it's your execution. So if the fundamentals are still solid, why do some investors still lose money? Investors assume that any property in a good location will perform. They buy into projects based solely on recent hype, completely ignoring how those same developers performed before 2020. The trap is people buying into oversupplied towers filled with near identical units. When handover comes, you're competing with hundreds of other investors trying to rent or sell the exact same product at the same time. That creates price compression and lower than expected yields as everyone undercuts each other. This is how you turn a good market into a bad personal investment, by buying what's easy instead of what's scarce. The risk in 2026 isn't a market crash, it's execution risk. You need to differentiate between the commodity units that appeal to traders and portfolio grade assets that appeal to end users who create long-term value. Focus on scarcity and quality. Buy from government-backed developers with full cycle track records. Choose prime locations like waterfronts and low-density villas. Target properties with balanced unit mixes that appeal to end users, not just other speculators. Work with an experienced fiduciary advisor who filters the noise and protects you from emotional decisions. That's one thing to understand these principles intellectually. It's another thing entirely to apply them to real deals in real time. That's why we offer personalized portfolio reviews, where we analyze your specific situation, filter out the high-risk developments, and identify the opportunities that match your strategy. If you want that level of clarity before you commit, book a call using the link in the description. So is 2026 the worst year to invest in Dubai real estate? Not if you know what you're doing. But even the best strategy doesn't work if you're investing in the wrong areas. So watch this video next.